Dennis Tubbergen here. I've got another market update for you. Today's April 30, 2018. It is Monday. I talked on today's economic update that John Malden talked about the inverted yield curve, something I've been talking about as well, saying that recession could be coming here based on the yield curve, which is a very predictable indicator historically speaking. Today, I want to talk to you a little bit about a few indicators here that tell us that stocks may now be in a bear market. One of those metrics that is often used is just classical Dow theory, and basically, classical Dow theory deals with the relationship between the Dow Jones Industrial Average and the Dow Jones Transportation Average. And if you take a look at the charts here, which are kind of hard to see, you see that there was a non-confirming peak in the Dow Jones Industrials on January 26, meaning the market made new highs. The Dow Jones Industrial Average made new highs, but that high was not confirmed by the transports. And then if you take a look here, we've got now a bear market signal as of April 9. Now, not every bear market is preceded by this Dow theory bear market signal, but all the big ones have been. Now, to just shift gears a second here, I'm going to get back to another page here. If you look at the Warren Buffett indicator, something that I've talked about, Warren Buffett's favorite indicator is the ratio of market capitalization, the total value of all stocks, to gross domestic product, which is basically the economic output of the United States. So basically, you take the total value of the market and divide by total economic output. And you can see that at market bottoms here in, for example, the early 1980s, total market cap was like a third of GDP. At the market peak, just prior to the tech stock crash, we saw market capitalization was 150% of GDP. And at the recent market bottom in 2009, it got back to 60%. Now we're back at 136% again. So very inflated value. It's really only exceeded that value one other time, and that's at the peak of the tech stock market. Now, the other thing I want to share with you is the value of margin debt. And this is an inverted chart, just to make it clear, but you can take a look here and see that the S&P 500 is up here over 2,500, and then the scale is inverted here, so you can see the relationship between margin debt and value of stocks. And if you take a look here at the tech stock peak, you can see that margin debt was these are both adjusted for inflation. Margin debt was about 420 billion. As it started to contract, meaning this line goes up on the chart, stocks fell. Margin debt, again adjusted for inflation, reached about $500 billion at the market peak in 2007. And you can see once it pulled back, we saw that the stock market started to correct. Same thing happened on the opposite side. As margin debt contracted and the stock market reached a low, this is back in 2009 at the market bottom. As margin debt built again, stocks rallied. And now look at the spread between the value of the S&P 500 and the amount of margin debt that exists. It is stretched extremely far. So we've got margin debt approaching $700 billion. That's nearly $750 billion. And stocks now have reached what are all-time highs when adjusted for inflation. Look at the tech stock correction that we saw back here when we saw a fairly significant gap. Another fairly significant gap here when the market peaked here. And then if you take a look at this level, we have this stretch so far that we tend to believe that this correction that is coming, that we believe will have to come based on all these valuations, will be a lot more significant than what we saw in 2007. So be prepared. It is a lot easier to predict the what than predict the when. Could the stock market continue to rise for another 6 months or 12 months? Well, it's certainly possible. We don't believe that it is likely. So best advice today, be prepared, hedge your open stock positions. That's today's market update. It's April 30, 2018, and I'm Dennis Tubbergen.